All right, so we should be all back now. Well, thank you guys, and welcome to the second half of day one of Ideate Innovate. And this is probably the main panel that sort of sparked the interest for everything that we're doing today and tomorrow. One of the ultimate resources for people working with entrepreneurs to get them funded, and some of the new programs that states are rolling out for funds as well. So without further ado, I'd like to introduce Carl Folks from the U.S. Treasury Department and Jennifer Teagan from New York Ventures, the Empire State Development Corporation, and I'll have you guys introduce yourself a little bit, and we'll get into the conversation. So, Carl, if you'd like to start.
Yeah, thank you. Appreciate the opportunity to speak at this conference, and nice to meet everybody on the call. I work at the Treasury State Small Business Credit Initiative, which we call the SSBCI. And it's a $10 billion program reauthorized last year from a program that was launched in 2010. What it does is it provides funding to states, and it requires the states to then apply to the Treasury with a program design that they've come up with for small business financing in their regional economies. And as part of that small business financing, supporting venture funds is a key opportunity for states to follow. And we've received applications from all states, all the territories, and the District of Columbia. And we will soon receive applications from tribal governments. So, the aggregate of all those are going to be roughly $9 billion or so. And so the states have varying amounts. The minimum amount each state gets is around 60 million. And the maximum a state has gotten is, I think, about $1 billion, perhaps, depending on the size of the state. So most states have put in applications that include support for venture capital. Some of those venture capital programs do want to support venture funds. And, that I'll be talking a little bit about, that program going forward, as we dig into the details. My background prior to taking this job, I was with the state of Hawaii. I managed the SSBCI program under the 2010 program. And we did run a fund program where we invested in about 7 different funds. And we were the first, anchor investor in most of those funds, getting them started. There was very little activity in Hawaii at the time. And, I certainly viewed the opportunity to stand up venture capital funds as transformative to our economy and very, very helpful in helping to diversify away from tourism, for example. So that gives you a flavor for the economic development objectives of some of these programs. But we do require in the SSBCI program that the state program find private capital to match with the federal dollars. And so that is a disciplining factor and requires any participant, whether it's a company, a fund manager, to be able to justify and get private investors into their enterprise that the federal government is supporting. So I'll leave that as an introductory comment, and happy to revisit the program in more detail.
Awesome. Jennifer, can you talk a little bit about yourself, background, and what you do with New York Ventures?
Yeah, thank you. It's great to be here and great to have heard all of the amazing insights. I was taking a lot of notes from the first part of the session because I'm about to embark on an emerging manager program for New York State, and certainly grateful to colleagues who have already done a lot of that work. So I'm Jennifer Teagan. I'm the managing director of New York State's program called New York Ventures, which is the state's in-house equity program. I sit within the small business division there, and our small business division is the one that is working with Carl and with Treasury on deploying the capital that New York State will be getting through the State Small Business Credit Initiative, which is $500 million for our state. And keeping in mind, some of that's going to lending programs and some to equity. So not all of that will be for equity. But my background is actually not all that different from Carl. I didn't work for the state of New York previously, but before joining New York State a few years ago, I was actually a private fund manager. I'm based in Ithaca, New York, which is not a hotbed of venture capital, although it's a hotbed of innovation because Cornell University is there. And so I managed for 18 years with two other partners a very small venture fund that received money through the original SSBCI program, and it was really important for our fund as an individual fund manager to help us to be able to continue to support companies across New York State, especially outside of the major market of New York City. And then the program overall now for New York State, the original program for New York State funded some over 80 companies, 7 fund managers, 80 companies, a couple thousand jobs, and has had some pretty extraordinary returns actually, including a company out of Buffalo, New York. Not a hotbed city of innovation, although it's actually up and coming for sure in that sector. But one of the investments that got made through the SSBCI program was in a company called ACV Auctions, which we're always proud to talk about because that was a company that in March went public and actually ended up returning nearly 30 times the money, at the time that it went public to the SSBCI program, at least on paper. So a great program for our state. Looking forward to the opportunity to deploy another emerging manager program. Emerging and regional manager, because emerging managers are important, but underrepresented or under-resourced regions are also very important to the SSBCI program and to the state to make sure that it's not all just going into New York City. It's great investing in New York City. It's very easy to invest in New York City, but there are great companies in Buffalo, Rochester, Syracuse, Binghamton too.
Yep, that's right. And Jennifer, if you could elaborate for a little bit. You think about, I'm sure you spend a lot of time with your team and with Carl's team thinking about, your programming and the impact you'd like to have. What are your hopes for the program in New York? And by the way, guys, like Carl pointed out earlier, there is many programs as there are states. So each state has its own program, and hopefully by the end we'll have a link or a website or some way to guide you to what the resources for your state is, or even consultants. But Jennifer, would love to have your thoughts on your hope for the New York program. Number one. Number two, the types of companies you're looking to invest in, and the same question around the types of funds that you're looking to invest in.
Sure. So our strategy with our equity program at the state currently is to really make sure that no matter where you're located or what your background, you have access to capital, or to grow and get your business funded. And while we work with the private sector, we don't ever lead deals out of our program. We're a matching fund, and we will continue to be through SSBCI. Fundamentally, that's the first filter is making sure that we're funding diverse founders.
Yeah.
And that we're getting it into regions that are under-resourced. And so underestimated founders and under-resourced regions. And then beyond that, we also look to support, of course, industries that are significant to the state of New York. Clean energy and climate, life sciences, healthcare, advanced manufacturing, agricultural technology, SaaS, data, AI, computing. And then being in the public sector, we love it when there's great public benefit of anything that we're investing in as well. And then, as far as an extension of what we hope to be able to do with, I actually came to New York State because honestly, I spent 18 years in the private sector and was really excited about the opportunity to have greater impact with the work that I was doing and the work that I love. But to be able to see the money get into the hands of more fund managers and more founders who haven't had a fair shake at the Capitol, and doing that with the platform of New York State behind me is a great way to be able to do that. And certainly the SSBCI program is going to provide us an amazing opportunity for that. So again, with this money, it'll be We haven't had a program where we've invested in fund managers since the original SSBCI. So it will allow us to do that again. And that will be it's intended to be $100 million multi-fund strategy program to invest in fund managers with a target for emerging and regional managers. Another program that we're launching is going to be a pre-seed fund. Because again, that's the area of access to capital that is really hard, raising that initial funding round, especially for people of underestimated background, who are underestimated as founders.
Yeah, generally no friends and family money, right? So, yeah.
Exactly. So we're really hoping that pre-seed fund will allow us to provide access to communities who have not traditionally had it. And we're also going to be working on some accelerators and accelerator partnerships. We find that, competition programs, accelerator programs often are also a good source of access in regions and for underestimated founders. So we're excited about that one as well.
Cool. And Carl, if we could just step back a little bit, you just put a link in the chat, so everyone may want to click on that so you have it stored and ready to go later. Could you just talk a little bit more about, you touched on it a little bit, but delve into the purpose of SSBCI and the various programs that you have. So for some of the guys that are real estate on here, clearly we're going to talk about venture, but you do other programs too, Carl. So you just give insight into what those programs are. And then I don't know if you have a list of the states that have been approved, but I've seen at least 5 states that have been approved publicly.
Yeah, just to start with your last question first. So the link I provided is to our landing page for the State Small Business Credit Initiative. And you'll see on there's a list of proposed programs and contacts. So these are all the state and territories that have submitted applications and their contact information, if you want to get information on their specific program. And then below that are the news announcements.
Oh, that's recently updated. This wasn't here previously.
Correct. So you gotta watch this site pretty regularly.
Yeah.
It gets updated. And below that are press releases, and you'll see in the press releases, we've announced now 15 states.
Oh, wow.
So
Okay.
there were 5 initially, then 9, and then North Carolina was announced late last month. And we're poised to announce another group of states who've been approved fairly soon. So it's on a rolling basis. We expect to get everybody approved over time. It does take time to go through the applications, to work with the state to get them into a format that we can approve. Yeah. And that's because the variety of the different programming we see is significant, and we need to understand what the state is attempting to do. They have an opportunity to stand up, as Jennifer mentioned, lending programs, and those lending programs can include guarantees that they provide to lending participants. It can provide collateral support. We find this to be very helpful for emerging companies who don't have the track record or don't have assets or something where they can post collateral that most lenders would like to see. So we provide that additional collateral in the form of cash to help them qualify for loans. Or the state can participate directly as a lender and participate alongside other lenders. Again, the key factor here is that there needs to be other private participants alongside the federal dollar program. And so in addition to that, there are the equity programs, and they're broadly two. They're either a direct equity program where the state program is investing as an investor in a company directly, or they are an LP in a fund and they go indirectly into businesses. So those are the broad categories of types of programming we see, but within that, there's tremendous variation. And so the main focus of the SSBCI program is A, they need to engage their private sector partners, but B, they need to be attacking underserved markets in some significant way. And one particular feature of this iteration of the program is there's a specific stream of money that's provided to states for what we call socially and economically disadvantaged individual financing. So by the acronym of SETI. And so these have to be deployed to companies which are at least 51% owned and controlled by members who fit the definition of what socially and economically disadvantaged is. And here in Treasury, it's defined quite broadly. I mean, there are ethnicity and gender and so forth classifications, but there are also classifications for geographically impoverished regions or rural communities, veterans or people who may have handicaps. So we try to be as inclusive, if you will, of people who have been historically underserved by capital markets. And so, those are the philosophy underpinning how we review and evaluate programs. And the states are responsible solely for their own design and for implementing and monitoring the programs. We do receive quarterly reports from the state programs, and we monitor their compliance with our overall rules and so forth. But we really rely on state partners such as Jennifer to, be able to manage and operate these complex programs. And so far, our experience with the 1.0 program, the previous one in 2010, was very good. States stood up very innovative programs, had tremendous impacts. We were able to leverage a lot of private capital for their small business communities. And we find the same level of enthusiasm and innovation in this iteration of the program.
Isabel has a question. And I think, both of you could touch on this. But this is a question I think a lot of people are going to have, just trying to understand, how capital is going to be deployed. For SSBCI VC programs, what are the rules in applying to states? And she says, my fund has 2 GPs based in California and New York, and the founders we are looking at investing in are all over the country. So I believe what Isabel is really trying to get into is, how could I get capital, and where would I be allowed to invest that particular capital? I don't know, Jennifer, you represent a state. I don't know if you want to talk about how New York is thinking about that. I think you touched on it, but I still think it's a nuanced issue that people are still trying to wrap their head around.
Yeah, so I can certainly speak to what New York's doing and what our limitations are around that. Carl can speak to the overall structure of the federal part of the program. But in New York State, the money that we provide to the fund managers will need to go into New York State companies. So there is that. I realize that having a geographic restriction on the funds is not ideal, but certainly from both the standpoint of the state, it's my job, and our agency is charged with economic development for New York State, not for Pennsylvania, New Jersey, or Rhode Island, right? So I need to, of course, answer to the taxpayers of New York State ultimately, and so that's where our money will need to go to. Now, a fund manager doesn't have to necessarily be in New York State to deploy capital in New York State. So there is that openness and willingness to work with fund managers who, we prefer, of course, that you would have an office in the state of New York. But if you are at least deploying capital here, and there's a nice intersection with things that we care about in the state of New York, and you have a particular thesis that really resonates and works for us, then we're certainly open to considering that. And I'll let Carl speak to the federal side, but our state legislature regulates our need to deploy the capital into New York State companies only. For the final, for the investments that the fund managers are making, the pass-through part of it allows us to have some flexibility.
Awesome.
Yeah, no, Jennifer, you answered it quite well. Treasury provides allocations to states, and states are responsible. So most states are very focused on economic development objectives for their regional economy. The federal program overall, the rules are 90% of the capital deployed needs to be in a New York State company for the purposes of New York's program. But that's 90% of the total allocation. So as Jennifer said, their total allocation could be 500 million or something, and so 90% of that. So if their fund program is only 100 million, as she mentioned, it's not 10% for each fund, they have a budget of 50 million, so to speak, that can be invested out of state. And if they choose to have one or two funds be a multi-state or a national fund, so long as they're keeping track and understanding where the money's going and reporting on that, that fund can invest outside the state boundaries, if you will. But that's up to the state to determine if that's beneficial to them or the reasons why they'd want to do that. And most states are very similar to Jennifer. They need to answer to their taxpayers and state legislatures. So they have probably stricter requirements than we do on that requirement. But
absolutely.
Yeah.
So we have another question from Tessa, who I think has actually raised a fund to the tune of somewhere, around north or south of 10 million. Tessa, thank you for your question. Is there a minimum fund size SSBCI would look to fund as LPs?
There isn't. And again, we leave it up to the states to define the parameters so that, they are looking to be involved in.
Yep.
So we know that a lot of the focus will be on first-time fund managers or emerging funds, and those tend to be at the smaller end of the spectrum. There are certain things that skew the deployment to these types of funds. Number one, there is a reporting regime, and I won't go into detail here. You can see some of the, there's a document on our website called Reporting Guidance, and you'll see all the data points that need to be reported into the federal program. Most experienced funds, may not want to put up with that headache if they can easily raise capital, without the public support. So, we're going to be trying to, as collectively as an SSBCI program, supporting, again, underserved communities, underserved opportunities, and, trying to get those opportunities up and running, getting a track record, and being able to then maybe, the next iteration raise capital from 100% private sources or others, but, be a sustainable part of the program. So there isn't a requirement for any particular fund size. As I said, there probably will be a more bias to earlier stage funds. And one of the other reasons is that there are two limitations on the use of money by the fund itself. And so that's first, that the program in its design has to target average transactions of 5 million. So again, a large fund, may be making investments in rounds of 15, 20, $50 million, and that will come outside of this round of average round of 5. So not, some could be larger, some could be smaller, but the average has to be around 5. And there is a prohibition that the fund cannot participate in any round of investing that is larger than 20 million. So again, takes you sort of out of the growth fund, anybody that's doing later stage investing. So it's going to skew, as Jennifer said, to earlier stage. It's going to skew to smaller. And that's where the opportunity will be.
Good. Jennifer, do you have any thoughts on minimum fund size that New York's looking at?
Yeah, well, first, let me congratulate you, Tessa, on raising your fund. That's awesome. Yeah, no, we're actually fairly open. We understand that emerging managers are, raising smaller funds, and so we certainly want to be able to address and work with funds of your size. That's our intent and plan.
Awesome. So another question here, and Carl, you started to talk about reporting, and just the onset, the thought of working with a government program like SSBCI is very captivating and alluring, with all those billions of dollars waiting to be put to work. But I think people are not on the website reading through the finer details, except for my lawyer. He's doing it right now. But what are some of the nuanced issues with the program that that may be unusual for fund managers? And we touched on our last call one instance around language for fees, for instance. But are there any special requirements, reporting, or different, in nuanced ways that the program should be managed that we're not thinking about, that we need to be thinking about having resources for?
Yeah, great question. It is a government program, and there are particular compliance issues. And, the access to the funding springs from a statute, right? There was a law passed that authorized this program. And so we need to adhere to the language of that statute. And so in that language, there is a distinction in how the capital is used. It can be used for administrative purposes, and then it can be used for investing and lending purposes, right? And so there is a cap that the program puts on administrative funds. This is meant to be money going to small businesses. And so we do limit the amount that states can spend on their own administrative or their partners' administrative infrastructure. And we require most of the capital, 90% or more of the capital to get to small businesses or support the direct involvement of companies. So with that in mind, fees generally fall under the category of administrative costs.
Yep.
And so it makes it very, very hard for states to support the fund expenses of funds they put in, given the cap. And so this program, we've included a feature in which we call services to portfolio companies part of the equity that goes into a small business alongside the capital of the fund. So sweat equity, if you will.
Yep.
And so recognizing that fund managers, spend an inordinate amount of their time working with their portfolio companies, trying to get them successful, trying to get them to scale and grow. And so we recognize that effort. And as, participants in the fund, the state should be able to help pay for those fund expenses. And so we've allowed a portion of the fund investment capital to pay for those services. And so there needs to be an agreement between the fund manager and the state program.
Yep.
As to what services will be provided and what will the cost of that service payment be. And generally it's in line with what you would expect fees to be for fund expenses. We cap it at 17% of the fund capital. So on average, it works out to about 1.7% over a 10-year fund on an annual basis. So it doesn't need to be 1.7 every year. So it can be higher in the beginning, scale down over time as the fund starts to liquidate and come to the end of its life. And so we peg that number at about what the average cost of a fund should be over time. And that can come from the fund capital. And so the states can additionally add to that expense ratio by taking some of their admin budget that they have to pay for some of the other fund expenses they may encounter. So it's a bit more complicated, but it requires some understanding on your side to what the requirements of the federal program are. But in general, it is meant to allow the state to participate alongside other private limited partners on the same basis that they're supporting the fund. So not paying any more in expenses, but not paying any less in expenses either.
Follow. And Jennifer, I don't know if you want to make a comment on that, but outside of that, are there any nuances or anything special or different about your program for fund managers that you think is nuanced and that fund managers are going to have to wrap their head around because it's done differently than a traditional LP?
Yes. Thank you for the question. It's I think the biggest thing for us is that it probably will make the most sense given some of the structural things that Carl mentioned, but also the restrictions around geography, et cetera, that we will probably for most funds be in a sidecar investment vehicle, which Treasury does provide for and allow for, with some parameters built around that as well. So instead of being an LP, in your core fund, we will sit alongside of that fund. You still have to have private capital in another fund in order to accept our funding, because there's the matching component to it. But and so unfortunately, I keep trying to think of ways to be able to not have to have sidecar funds, but I think given some of the limitations, that will end up making the most sense for us at New York State and for the fund managers, although it does create a little of some additional administrative burden. So that I don't like, and expense, although we'll try to, work on covering, what expenses we can for the fund managers to be able to accept those funds into that structure with the other fees that we get.
I'm trying to wrap my head around the purpose for the sidecar fund. Is that to allow funds to invest in whatever regions they want to, but if they want to take your funding, generally speaking, right, up to 90%, whatever that number may be, they have to invest in New York companies. So the sidecar fund, it would be a fund where you'd only be tapped on to investing in New York companies. So it gives us the flexibility to invest wherever we want, but when we pull on New York Ventures funding, it's in a New York company, and we could use the sidecar fund to invest alongside our fund.
Correct.
Yeah, another purpose is to address this $20 million round size prohibition. So although, as I said, most of the funds might be smaller or early stage, perhaps there's a portfolio company that just scales rapidly, and the fund has an opportunity to participate in a very, very large round of a successful company. Whether the sidecar, structure is used or not, there may be a mechanism where the SSBCI capital doesn't come into that round. So the fund still and the other LPs can benefit from that round, but the SSBCI program will sit out. So there may be circumstances like that. And one of the other ones that's quite prevalent is cannabis and marijuana related businesses in many states are legal, but at the federal level, they're not legal. So again, SSBCI capital cannot participate in those types of companies, that the fund may want to invest in. So, there are circumstances where the sidecar makes sense for the state on a compliance basis, just to, keep them and the fund out of any trouble.
Okay. I got a text. Guys, you could actually just use a chat feature in LinkedIn. I haven't been paying attention to my phone, but text question. If the fund is purely for New York, is there a purpose of creating a side fund? I think Carl just touched on that. It's not only for the region, it's for some of the finer details as well. So Jennifer, my assumption is, and correct me if I'm wrong, or you should probably talk about it, not me, but if someone is focused on in-state investing in New York, do they still have to create a sidecar fund?
As long as they can adhere to the other requirements of the program, and it doesn't conflict with anything else in their core fund, and where we would be fine to be an LP inside of it.
Great. So the point being, as long as the LPA is in line with everything New York wants and everything the federal government wants, then fine, you can have it. And no one should be playing outside of those rules. So it'll work to have a fund that plays by the rules. Okay. Some restrictions, but you get it done. If you want to, it gets done. All right, got it.
My way of thinking, is that the requirements are spelled out, but they're not much more than an institutional LP might require, right? So it does get you used to some rigorous framework for having to report in your transactions, keep on top of things, keep good books, account well, be able to, report accurately, all those types of things. We're not asking for any more than probably what an LP would want to know. What kind of fund, what kind of company have you invested in? What type of instrument, how much exposure do we have? All that type of stuff. So.
And there's another question right before I get to that question. Let me ask: is there and there probably is there a document with on Treasury's website that outlines what you'd like to see, Carl, with all the restrictions, etc.?
Yeah, it's not the easiest document to read. There isn't a cheat sheet, so you have to read the entire document.
Yeah.
But it's called the Capital Program Policy Guidelines. It's on the website. And in addition to that, we do publish from time to time what we call FAQs, which are updates to those guidelines, which put refinements in on the general policy that has been published earlier. So, for example, the sidecar issue that Jennifer brought up was recently published in a FAQ.
Jennifer, do we have a similar resource as the capital program policy guidelines for New York?
Sorry, Boris, you cut out for a second for me. I didn't catch all of your question.
Do we have a similar write-up or policy guideline publication for New York around what our investment agreement with New York would look like or should look like?
We don't yet. Our program hasn't been announced officially. But once it's announced and we're ready to start accepting applications, all of that information will be available on our website. And if you Google New York Ventures, Empire State Development, or just New York Ventures, you should be able to find our esd.ny.gov site that has our program information on it. But I would encourage you, we've been talking and planning on this program for a little while. If people are interested, we do have a running list of fund managers who are, so please feel free to reach out and email me. I could even drop my email in the chat. I'm very happy to have people message me to put them on the list to get notified of when our information goes live.
Yeah, email and LinkedIn guys. Someone asked a question about not being able to find Carl, folks. Carl doesn't do social media, so you won't find him. But you never know. My daughter isn't supposed to be on social media, but she has these ghost accounts where no one knows it's her, but she's following everyone. So FYI. So some other questions here. Is there a time requirement from Treasury for private match to be raised? Let's say 90 days, etc. And I'm thinking, Derek, I could be wrong here, but essentially, I'm assuming the expectation is you have a capital commitment and agreement in place already. But I'll let Carl and Jennifer manage that question. So is there a requirement from Treasury for private match to be raised in a certain amount of time?
For a fund, if we want to speak specifically about funds, there isn't a specific timeline. We envision that, again, the state programs will operate similar to a limited partner. They'll interview and look into opportunities for funds. They'll make a soft commitment subject to, an adequate amount of capital being raised for that initial close. And once that initial close happens, then they'll put funding in. So the state, however, is under a 3-year time frame. They receive their allocations in 3 tranches. They don't receive it all at once. And so to qualify for the second tranche, they need to deploy 80% of their first tranche within 3 years. So they're on a 3-year clock to be able to show that they've deployed 80%. So they can't wait forever for you to close your first close. So they may have requirements in and above the federal guidelines. But for fund investments, we understand it's a process. It takes time. And clearly, we would like states to participate in the initial close. That would make it easier. I can speak to some of the complications that happen that are, related to conflicts of interest and so forth that arise out of second close opportunities, but it is possible. But usually second close, again, the time clock is in the LPA. There's a specified period of time the fund must raise its target amount, final target amount. And so again, the parameters are not necessarily treasuries, but market-based there.
Okay. And just to continue the process of demystifying what's going on here, Victoria Kennedy has asked, a question. Has New York started investments already into funds? If so, what has the average timeline been from initial contact to making a decision to invest? And I think I know what that answer is, but before we let Jennifer go, Carl, after Jennifer, maybe you could talk on what some of the experience has been looking like for some of the states, if they have an LP sort of program. But Jennifer, any thoughts on that question?
Yeah, so we haven't started to deploy capital yet. We're actually in the final throes of our approval process with Treasury. So announcements will hopefully be coming soon on that. But yeah, the program is not up and running yet, Victoria. So it's still to come. It's going to take us, once the approval is final, it's going to take us a little bit of time before we're ready to hit go, because there's a lot of other players in the state and systems and things like that we have to adhere to, that we're still working on requests for proposals, requests for applications, and all of that. We have a lot of that, started, but even just hiring the team to help us to deploy it is work that still is ongoing right now. So, but I expect by once we sign our allocation agreement with Treasury, we have 90 days to get the programs up and going. So that will be, hopefully that by the end of this year, early next year.
Carl,
no later than.
No later than end of this year. Great. Any thoughts around how long it's taken to, the average timeline to deploy capital for one of the state programs into a venture fund?
Again, the experiences are so varied based on the state involved. Many states have had existing fund investment programs, which either were previously funded by SSBCI or by other state programming. And so they have an agency, a team, and a pipeline, so to speak, right? And so they can move quite quickly. So we see a few states that have been approved already, poised to invest in their first funds. We had one state, for example, that was almost going to lose the opportunity. They were keeping it warm. The funding window for that fund was going to close in August. And they didn't get approved, I think, until late June. And so, they're going to, I think they've closed. I haven't checked back with them, but but other states are standing up programs for the first time.
Yeah.
They may need to hire staff. They may need to, some states have a procurement policy where they need to RFP for the funds. And so that process has to play out. There's, again, can't really say with any specificity. These are state designed programs. There's no real mechanism that Treasury enforces other than, the 90 days to be operational once they receive approval, and the 3-year window in which they need to be able to show deployment of funds to get the additional second and third tranches.
Okay, and this is a LinkedIn question. And I think this is a real concern, particularly for new managers. And I think I know what the answer is, because we just talked about partners investing or private markets investing. Would states be able to warehouse deals for funds? Amazing deal in your region. The fund isn't completely raised yet. Would you be able to warehouse that particular deal?
Yeah, for Treasury, it may be difficult for the SSBCI capital to participate. We have a very strict conflict of interest requirement, which is one of the features maybe slightly differentiating the federal dollar from a private dollar. So we don't allow recusal or other mechanisms. There's a flat prohibition on SSBCI capital going into a company in which the general partner has a personal financial interest. And so, a warehoused investment probably falls into that category. And then we have a similar problem in that in the guidance, we do not allow SSBCI capital to support the transfer of equity from the company. So it's supposed to be new capital that goes in and grows the company. It cannot be capital that goes in and takes out another investor, for example. The only exception to that is we do allow funding for employee stock option plans that are buying from an owner and then transferring ownership to employee-owned groups. So that's the only time in which we do support the transfer or purchase of ownership.
Great.
So, in an equity scenario, it's additional shares that are being, none of the existing shareholders are being taken out. And that's something you need to look for in the deals that you fund. You can't fund the exit of founders, for example.
Perfect. So we learned a little bit about where we can get additional details about the SSBCI program from Treasury. Carl put the link in the chat, everyone. And Jennifer has given us insight into where we can get additional information about her platform. And I'm assuming that would be at the Empire State Development Corporation website, and then looking for New York Ventures.
Sounds great.
Right. Let me see.
Yeah, I would add, Boris. Yeah, so you have the link to the SSBCI website. I would encourage you to read through the materials you see there. There is that Excel spreadsheet. Well, I think it's probably Adobe, but that lists all the states and territories and their contact information. That will be updated regularly, as state programs start to be approved and put online. There'll probably be specific, websites for each of the different programs. We hope to have that information. If the state's willing to provide it, we will post it. But I would encourage you to talk with your state programming people. I'm sure Jennifer can speak to how her group is working, but they are available for you to contact and find out more about their program.
And guys, Jennifer just put the link for New York in the chat, so you may want to click on that before we wrap up. It's 10 minutes to the top of the hour, so we wanted to have a little bit of time for networking before I close down around 2. Final question, wrapping things up. Jennifer, Carl, around consultants, are there any consultants nationwide helping funds think through how to apply for SSBCI funding? Not that we're giving recommendations or anything, but are there groups out there already doing this work?
Yeah, I haven't looked specifically for that, and we've been working primarily with states trying to get their programs approved. Many states have consultants that they use to help design the programs, so we've been working, with that sort of community so far.
Got it.
I'm sure, once we, get programs stood up, we'll switch to be more involved in implementation. But I'm not that involved right now in that aspect of it.
Okay. Any more closing remarks, Jennifer?
I was just going to say, we haven't accessed consultants yet. The program design we did internally because we have the experience on our team and expertise to do that. We probably will engage with third parties to help us to manage the programs once they're up and running, though.
Yeah. Perfect. On that end, I will end our first day of the Ideate Innovate VC Symposium. Thank you, Carl. Thank you, Jennifer. We could stick around to do a little bit of networking for whoever could stay on until 2 o'clock. Tomorrow we have Carta that's going to talk about a lot of cool stuff. So I didn't know this. I found it out in our planning call. Carta can help you do fund formation for free, unless you don't end up raising the fund and you have to pay them $10K, but that's a lot better than the $100 to $200K you'd have to pay for a standalone law firm. And then they have all these startup resources, including their amazing platform. I'm not doing an ad for Carta. They're not sponsoring, but this is all about lowering the hurdle. And right now, I think that is probably best in class from an innovation standpoint. And then we also have the London Stock Exchange speaking about how to get to exits. So what's new and different about the London Stock Exchange is their whole ecosystem came together differently, right? They didn't have a traditional venture capital community, and they don't have something like the NASDAQ. They're, if you watch Downton Abbey, they're pretty old school still. So they have traditional older companies paying dividends, but they started a junior market to IPO like Series A companies, right? And then to grow them. So it's going to be very interesting to listen to that and to dispel all these notions of improprietary or a weak market for their alternative investment market that probably had a hiccup 10 years ago, but has changed since. So that's what we have coming up tomorrow. Thank you, Carl. Thank you, Jennifer. Guys, if you want to stick around for networking, I'm going to start the networking in about 30 seconds.
Thanks, Boris. Appreciate the opportunity.
Thank you.
Yeah, thank you so much. Thanks, everybody, for joining.
Yeah, thank you, Jennifer.